Now let's get into the world of investing in financial instruments and how we show them on the balance sheet. So, first of all, what are we talking about over here? We're talking about financial assets such as stocks, bonds, and other financial assets such as derivatives, loans, and receivables. But primarily in our discussion, we're going to be focusing on stocks and bonds. And before we go ahead with this discussion, I want you to first appreciate the difference in income statement and statement of comprehensive income. And we've discussed this before when we were talking about the analysis of income statements, that even though you have your four primary financial statements, such as your balance sheet, income statement, cash flow statement, and your statement of changes in shareholders' equity, right? But there is a fifth to all this. Now, why we didn't tell you earlier is because a lot of companies, and you're allowed to do that, they just show it as part of the income statement, and some companies they show it separately. Now, what is the statement of comprehensive income? There are certain gains and losses which are unrealized. So, if those gains and losses are unrealized, they are not shown on your income statement, because income statement is usually for realized gains and losses, right? And we've already seen how we show the realized gains and losses of on your income statement after the gross profit, but the unrealized ones don't get shown on your income statement. They get shown on the statement of comprehensive income. Now, why is that so important? That's very important because your earnings per share, as you should remember from your previous learning module, your earnings per share is calculated based on your net income minus, let's say we're doing the basic EPS calculation. So net income minus preferred dividends divided by weighted average number of common shares. So that net income is actually coming from income statement. The statement of comprehensive income has nothing to do with net income, which means if there is some unrealized gains and losses, they are not going to impact your income statement, and therefore they're not going to impact your net income, and therefore they're not going to impact your earnings per share. And for the CEO of a company, it's very important that they maintain a certain stability in the earnings per share, and it shows a stable growth, right? They don't want volatility in your earnings per share. And these unrealized gains and losses can be volatile. So, what we want to do is invest in stocks and bonds, but these investments we know can be volatile, but we don't want the volatility of these investments to show in our earnings per share. We want that volatility to be unrealized and impact the statement of comprehensive income, but only when the gains or losses are booked. Once they are realized, should they have an impact on the income statement and then have our impact on earnings per share. Now, how do we go about doing this? It all depends on what you say when you're buying that asset, right? So it has to be categorized. The measurement basis depends on how the financial assets are categorized upon acquisition. When you acquire those assets, right, what do you say is the reason for acquiring those assets? That will depend on whether you measure them at fair value or amortized cost. Now, let me tell you the three reasons that you can have. The best reason, as far as not having any volatility impacting your earnings per share, is something called held till maturity. And this you can only do for bonds. You can't do this for stocks because stocks don't have a maturity date. they are having an indefinite life. Bonds, on the other hand, of course, have a certain maturity date on which they will pay the face value, and until then, they will pay a coupon payment. So, since you are declaring on the date of acquisition of this bond, when you are purchasing this bond, as the CEO of this company, you are saying that, hey, I'm buying this bond with the intention that I will hold it till maturity. And therefore, whatever price of this bond is going up and down in the market, I don't care for that volatility because I am not looking to sell it. I have the ability to hold it till maturity. I have the intention to hold it till maturity, and therefore, the market volatility of its price, its fair value, does not concern me. And therefore, the unrealized gains will not be recorded at all. So here, unrealized gains or losses not recorded at all, right? So that's the best situation you can have. But then the cost of having that situation is that you cannot sell them until they mature, right? And even then, of course, you're just going to get the face value back. You're not going to be selling them. So you're going to be holding these investments to maturity. Now, the middle path over here is something called available for sale. And this means, okay, we might keep holding them forever, right? You can even do it for stocks, or we might hold them till maturity. But if we want, we might sell them as well. So they are available for sale. But you can't sell them very, very quickly, in the sense that you can't sell them within a few, approximately, I believe it's around 90 days. So you can't sell them within 90 days of buying, but then you can sell them after 90 days. If you want to sell them within 90 days, that is called held for trading. So if when you are buying a certain stock or a certain bond, if you have the intention that you can sell it immediately within 90 days of buying, then the unrealized gains and losses, which means the volatility of the price movement of this stock or bond, whatever you have bought, right, is not only going to be recorded, it is going to impact your income statement, which means it will impact your earnings per share. So unrealized gains and losses recorded in income statement, not statement of comprehensive income, in the income statement, which will of course impact your net income, and it will impact your earnings per share. So as a CEO and as the CFO, you better be very careful if you are buying something and reporting it as held for trading, because that volatility of its price, of its fair value, which will be either determined by the market price if it is a listed security, or otherwise there are other ways of coming up with an estimated fair value if it is not listed. But the point is that whatever is the volatility of that investment, that will be impacting your EPS. And as a CEO, you don't want a volatile EPS. You want a stable growing EPS. Now in the middle, you have available for sale, and here unrealized gains and losses are recorded. Gains, losses are recorded, but they don't pass through your income statement. They are recorded in the statement of comprehensive income, right? Which means they are recorded. If your stocks or bonds are going up on the balance sheet, your asset side will be going up, and on your right side, your equity will be going up, right? But it's not going to pass through the income statement and show the profit and record the retained earning. So your retained earning will not be going up. It is your accumulated part which will be going up, which is unrealized. But I don't want to go into the details of which exact equity account goes up. The point is that in both of these, available for sale and held for trading, the change in the value is recorded and it impacts your equity. So if the asset is going up, your equity is going up. If the asset is going down, your equity is going down. In held for trading, it passes through the income statement, so it's even impacting your income and EPS. However, in the case of available for sale, it does not pass through the income statement. It is recorded in statement of comprehensive income. So the volatility does not impact your EPS calculation. And of course, in the case for held till trading, it's not recorded at all. The unrealized gains and losses are not recorded, right? So it's very, very important that how you categorize them on your acquisition date. This was for the unrealized gains and losses. As far as held for trading, available for sale, and held till maturity is concerned, the realized gains and losses are going to go through the income statement and ditto. For all three of these situations, if you realize a gain or a loss, right, or whether let's say you receive some dividend or some coupon from that bond or stock, right, it will also go through the income statement. So if you're realizing a certain gain or loss, or if you're having some income coming in, whether it is a dividend from a bond or a coupon from a stock, that of course is going to pass through your income statement in all situations. But it's the unrealized gain and loss that here is not recorded in the held till maturity. Here it is recorded but passes through your statement of comprehensive income, and in your held for trading it is recorded and passes through your income statement. Right, now IFRS has different names for this. So held to maturity is known as measured at cost or amortized cost. And why they are using this word amortized? So usually sometimes what happens, let's say if I buy a bond, and let me give you an example. Let's say Amazon issues a bond paying, well, it has issued a very low paying bond, but I'll give you a higher example. Let's say it's paying 5% coupon, and the interest rate goes down in the market to 2%. The Federal Reserve reduces the interest rate. So everybody will rush to buy this bond. Then what will happen? Let's say this bond was originally issued for 1,000. It's becoming expensive in the market. Let's say it becomes 1,100 because everybody wants to buy this bond because it's paying a higher rate than the interest rate. So the price becomes 1,100, right? But at maturity, it is going to pay you 1,000. So if you as a company are buying this bond for 1,100, but you know at maturity it is going to pay you 1,000. So initially on your books, you will show this asset at the value at which you are buying it, but slowly you will reduce it or amortize it to what you are going to get when it matures. So you will amortize this cost and it will basically be reduced on your balance sheet as you move towards maturity. So every year you will reduce it a little bit, and that is the process of amortization. So if you are buying something with the intention of holding it till maturity, then it is measured at cost or at amortized cost. However, if you are having the intention of selling it after 90 days and before maturity, then you can say available for sale, or it is also called measured at fair value through other comprehensive income. And if you are going for held for trading, you want to sell it within 90 days, then it will be measured at fair value, but the unrealized gains and losses will pass through your income statement, or also called your profit and loss statement. So let's discuss this again in a little more detail, each one of them separately. First, held till maturity. They are measured at amortized cost. And how do you come up with that amortized cost? Of course, it depends on what will be the face value, right, that you will get at maturity, which is your principal, and what is all the interest payments that you get until that date arrives. So if you're investing in a long-term bond, the unrealized gains and losses will not be recorded anywhere because you're holding it till maturity, and it doesn't matter what the volatility in the market is going to be. Right. Next is your available for sale, and that is going to be recorded. The unrealized gains and losses are recorded, but they don't pass through your profit and loss statement. They don't impact your earnings per share. They just impact your other comprehensive income. So yes, it's going to impact your balance sheet. If it's going up, the asset will go up, and similarly your equity will be going up, right? And if the asset is coming down, equity will go down. It's just that it's not going to flow through your income statement. It will not impact your net income. It will not impact your earnings per share, but nevertheless the balance sheet will be impacted. In the case of held for trading, not only is it recorded, they also pass through the income statement, and therefore they are going to impact your net income and EPS calculation, right? So here is a nice summary, and we're talking about the treatment of unrealized gains and losses here primarily, right? So unrealized gains and losses shown on the income statement for your held for trading, also called measured at fair value through profit and loss, or as far as IFRS is concerned. For your available for sale, called measured at fair value through other comprehensive income, the unrealized gains and losses are shown in the OCI. And your held till maturity, also called measured at cost or amortized cost, as far as IFRS is concerned, they are not recorded. The unrealized gains and losses are not recorded anywhere, right? Realized gains, of course, for all of them will flow through the income statement, and even the income from all of them. So income could be dividends for stocks and coupon payments for bonds. So that of course will flow through your income statement as well. What is the concept of mark to market? So where are you getting these unrealized gains and losses from? So the unrealized gains and losses come from something called mark to market, where let's say you bought Apple stock for $100, and then in the market it went to $200. So definitely you're going to and you haven't sold it yet, so but still you're going to record an unrealized gain if you bought it and you showed that it is either held for trading or available for sale. And if you showed it as available for sale, this unrealized gain is going to be shown in your other comprehensive income. And if you showed it as held for trading, then it will pass through your net income. But nevertheless, the unrealized gain will be recorded for stocks, because you cannot declare that stocks are going to be held till maturity because they never mature. If this was a bond, you could then of course have the intention and declare the intention that I will hold it till maturity, and therefore you will not have to record the unrealized gains, and you will not even have to mark them to market. But if you have a security which is either declared as held for trading or available for sale, then you have to do marking to market, which means whatever is the price based on the market price, you need to adjust that value in your assets and update your equity accordingly. Let's take an example. And here we're going to look at all three categorizations. So we've got a bond, 20-year bond, 5% coupon, semi-annually, bought for 100,000. First payment, so this is your income coming in, 2,500. And income, as you know, for all three is going to be the same. It will pass through the income statement. However, the market price has increased. So this unrealized gain of 2,000, there is an unrealized gain of 2,000. This is going to be different, right? For held till maturity, it will not be recorded. For held for trading and available for sale, it will be recorded, but the difference will be that in held for trading, it will pass through the income statement. Available for sale, it will not pass through the income statement. So let's have a look at the solution, and let me discuss with you each of these one by one, starting with the held for trading, right, which will flow through your income statement. So the income that you got, which is your $2,500, will definitely pass through your income statement and impact your retained earning on the equity side. Plus, the unrealized gain will also pass through your income statement, and a total gain of 4,500 will be recorded of on your income statement, which will be 2,000 for unrealized gain and 2,500 for the interest income. Now, for your available for sale situation, it will be exactly the same. The only difference is the unrealized gain will not pass through the income statement, rather it will flow through the other comprehensive income. Everything else will be the same. Only difference is that it will not pass through the income statement, it will pass through other comprehensive income. And of course, for your held till maturity situation, we are not going to record the unrealized gain. We will only take the income, right, of 2,500, and that will be shown as interest income on the income statement, and it will be shown on the balance sheet as cash, but the unrealized gain will not be recorded and will not be shown, right? And that is it for your financial instruments discussion, and we're going to take up the discussion of non-current liabilities in the next video.